Okay, maybe one of you could tell me another use or operational advantage or another use for derivatives. Because I've listed down some here, right? Can you think of one more and then before we move on? Anyone? What else do you think you can do with options? Do you know what is synthetic?
I think it can for employer can like option like a reward for their worker, like maybe.
Okay, so what? That's a different type of option. So what option is that?
It's like the send some option to the workers and say the company is good. Share price will get higher, and you can get the company.
Yes. So those are executive stock options, right?
Yeah.
So what is the difference between executive stock options that you talk about and the options that we have been talking about in the first hour? Does anyone know? Do you want to say something? Okay, the options that we have been talking about in the first hour, those are what you call exchange traded options. Okay, now exchange traded options has nothing to do with a company. So I could have options on ABC stock listed on the exchange, and people can trade their options. Now that option has nothing to do with company ABC. Okay, so by buying the option and exercising the option does nothing to the company's shares. Okay, it is in the market. So if I bought a call, exchange traded call, and I exercise that, and I pay the strike price and I receive the stocks, right? Now those are within the market. The company doesn't issue any more stocks for me. Okay, now the kind of stocks that the gentleman, the stock options that the gentleman talked about just now are executive stock options. Now executive stock options are different in a sense that those are issued by the company, and exercising those options lead to new issue of shares. Okay? So if a company doesn't issue new shares, then all the issued capital that is traded is in the market, right? And of course you can't trade, let's say a company has 10 million shares, you can't trade all that 10 million shares because the founder may hold some, investment houses may hold some, and these are not liquid, right? So what you're trading is only the free float, which is part of the issued capital. So when a company issues stock options and you exercise that, that leads to new issue of shares. So the issued capital increases. Okay. Now that's not the only difference. With executive stock options, now by buying a stock options, now you know that when you acquire shares, you are entitled to dividends, right? When you acquire shares, you also have voting rights, correct? If you're an ordinary shareholder. Now, by simply buying options, although it gives you the same payoff of a stock, it doesn't give you those rights, okay? So you don't have entitlement to dividends, you can't vote in the company's AGM, although you can participate in the payoff of the stock. Any more questions? Okay, another significant advantage of this is that you can create what is called a synthetic. Okay, does anybody know what a synthetic is? Did Artie talk about synthetic before this? Yes or no? Okay, you got to speak up because I don't know whether you understand or not. Now, okay, now imagine this. If you were to be invested in stocks, what are you interested in? Well, some people might want to acquire a controlling interest, some people might want to run the company, some people might want the voting rights, some people might want the dividend, right? However, by and large, people who buy stocks, what are they after? They're after the returns, right? Returns of the stocks, agree? They're hoping that the stock might go up and they can sell at a profit. Now, you don't have to do that. With options, you can similarly achieve the same objective. Okay, so if I'm interested, so that's called a payoff of the stock. Do you understand? Do you follow? Okay, so the payoff of the stock is the return, right? Whether it's capital returns or dividend yield. So instead of buying the stock, I can make use of options to achieve the same purpose. So I can create a synthetic payoff. So what it means is that I could, instead of buying a stock, I could simply buy a call. The money that I'm supposed to use to buy a stock, I can invest in a bond or park it in the bank to earn me interest and short a put. So by doing all three things, it will give me the same payoff as if I'm buying a stock. Okay, so that's what is called put-call parity, which we will go into greater detail later on. But that's a significant advantage of using options. Any questions, clarification? Okay, so in options, we're going to look primarily at two types of options. One is index, one is equity. Now, index options, as the name suggests, are options on an index. So it's on the market. So index can be the whole market, it can be sector. So you can have subsector index as well, right? You can have large caps, small caps, mining index, which is sector index. You can have gold index. So you can have all sorts of index, but by and large, they represent the market or they represent part of the market. You follow? Okay, so we can have options on index. Now, we can also have options on single stocks. So you can have option on, let's say, ANZ shares. Okay, so with option on a stock, all you're addressing is the risk associated with that stock only, not with the market, right? Whereas an index option, okay, so with index options, you address the whole market. Okay, now there are reasons for using index and options depending on what kind of risk you want to hedge. If you are thinking of hedging market risk, systematic risk, of course you want to use index because they represent the market, right? And if you want to look at individual risk, then you look at individual stock options. Okay. Any questions? So they both have different expiration date as well. Index options typically expires on the third Thursday, and equity options typically expires on the Thursday before the last Friday. Okay, you can check that up on ASX website. And we will also look at two types of options, primarily call and puts, and whether they are call or puts, we will also look at two types of options called American or European. There are actually more than that, which you will look at towards the later part of the course. There are also Asian options. Okay, so we'll look at that later on. Now, what's a put option? You took a lot of notes. What is a put option? The right to sell. So when do you buy a put option? When you think the market is going up or down? Going, different answers, right? I hear some. Up or down? Down. Okay, very good. When you think the market is going down, right? Because you want to sell, right? So conversely, you buy a call if you think the market is going up. Why is that so? Because if the market is going up, the value of the call would go up in tandem. Okay, so you could then exercise your call and buy the stock at a lower price, because if the stock price has gone up above the strike price, then you're profitable, right? Then you buy back at a lower price. Or if you don't want to do that, you could also simply sell your call into the market because the value of your call has gone up. Okay, so either way you can make a profit if the market goes up, and conversely with puts. So what's the difference then between going long a put and going short a call? Do you want to make a guess? The lady beside you? It's okay if you get it wrong, right? Because then we all learn. What about you, ma'am? What's the difference between going long a put and going short a call? Long means you buy, right? Short means you sell. So what's the difference between buying a put and selling a call? Okay, I want you to understand this. I'm going to throw questions like this to you every lecture. The idea is to start you thinking about it, okay? Because if you don't get all of this correct, towards the later part of the course, you find it quite hard to follow. Okay, so right from the word go, you must be able to tune yourself to think in certain manner. You must be able to flip from calls to puts easily and things like that, okay? Do you want to answer or? Okay, long call.
Long call.
No, I'm talking about short call.
Short.
You see, a lot of people have this problem because it's always long call or long put, right? So when you turn it to short, then, sorry, they get a bit of a problem. So what's the difference between short call and long put? Okay, you want to? So confusing. That's the whole idea of this question, so that you sort it out in the beginning. Do you want to give it a go?
I'm not pretty sure.
Never mind, just I'll correct you if you're wrong.
I think long run, maybe someone wanna
Okay, tell me long put first.
not put.
Yeah.
Maybe someone just wait for the contract into the
It's 10:30.
expiry and to get a dividend.
No.
Yeah.
We're not looking at that yet. Anybody? But thank you anyway. Anyone?
I think maybe it's because you think the price will going up, but you are not very sure about that.
Long a put.
Yeah.
I thought we just discussed that to long a put is because you think the market is going down, right? Because when you long a put, it gives you the right to sell, right? So you sell when the market is going down. Yes.
I think there are more problems with the short.
More problem with the short. Why is that so?
Yeah, actually, see. For example, if you long a put, you get the right, but if you short a call, when the
Do you have the right?
when the exercise price, let me see, the short call, when the exercise price is
Okay, I'll help you out.
under the stock market price, you get an obligation to deliver the underlying asset.
Okay, you're on the right track. So essentially, when you buy an option or you long an option, you have the right, but you have no obligation. So if things don't work for you, you can walk away. Now, if you short an options or you sell an options, you don't have the right to walk away. You only have the obligation. Okay, so you take both transactions because you think the market is going down, right? So if the market is going down, you can either short a call or you can go long a put, right? However, doing one or the other makes a difference because if you short a call and you're wrong, right, and the market goes up, then you end with the obligation. And the obligation would then, you will have to deliver the underlying at a loss, right? Whereas if you long a put, and if the market goes up instead of going down as you think, you just lose the premium and you walk away, right? Okay, so there are important differences that you need to note. Okay, so American option allows one to exercise the option on or before the expiration date, whereas European, you can only exercise on expiration date. So here's the thing I want you to think about. At expiration, would an American call worth more or less than a European call? I hear somebody say something from here. More or less. An American call would worth more than a European call at expiration. Does anybody has a different answer? Why do you think it is worth more? More? No, at expiration. Okay, at expiration, what happens to an option, regardless of whether it's American or European? It either expires worthless, okay, or is in the money, right? And if it's in the money, what is the value of the option? Simply between the underlying price and the strike price, right? So there is therefore no difference between an American option and a European option at expiration. Does everyone follow? Because at expiration, everything is the same, right? Whatever the stock price at expiration is the same for both options, and you can't exercise early anyway because it's expired already, right? Now, prior to expiration, an American call can be worth more than a European call. okay, or American option can be worth more than a European option, but it's not always the case. Okay, just because you have the right to exercise early doesn't mean it is more valuable. All right? Many people think that I have an option to exercise early, so therefore it must be more valuable. Now it's not necessarily so. Okay, be careful. It depends on the circumstances. For example, whether the stock issues a dividend or not. So you have to evaluate whether or not that right to exercise early or that ability to exercise early is of any value to you or not, because at some points in time it may be valuable, at some points in time it may not be valuable. So we look at that when we do binomial model. Then we will assess at every time interval before expiration whether it's worthwhile to exercise your American call or not. If it is, then of course your American call will be worth more than a European call. Okay? Any questions? Clarification? Oh, this theater doesn't have a clock. What's the time? How much time do we have? 10:30? Okay, thank you. Okay, the premium. The premium is what you pay for the option, right? So if an option is listed in the market at, let's say, 70 cents, so that is the premium. Okay. Now you can look at the premium in terms of something that you pay as a consideration for acquiring the rights if you buy an option. Okay, because you pay something and you acquire the rights. Now conversely, if you sell an option, do you pay the premium? You receive the premium, right? So that is a compensation to sellers to assume the obligation, because sellers don't have rights, right? Now, who is going to assume the obligation if you're not compensated for it? No one, right? Agree? Yes or no? Okay, exercise or strike price mean the same thing. They are the price for which you can exercise the option and pay or collect that price, whether you're a buyer or seller. Okay? So exercising an option is, of course, when you say you want to exercise an option, you pay the strike price and you receive the underlying. Now what happens if you forgot that you have some options and it expires today and it's in the money, it's valuable? What happens? Does it mean you lose all your money? What do you think, ma'am? What happens to an option if it's in the money and it expires and you didn't exercise it? Okay, you don't lose everything, okay? Because by default, all in the money options are exercised at expiration automatically. And how are they exercised? Well, it depends on exchange. It could be assigned at random. It could be assigned on a first in, first out basis. So typically, roughly 15% of options are exercised, 25% expires worthless, and the remaining 60% are basically closed out before expiration. Close out means if you bought the option, you can sell it back to the market. If you had sold the options, you can buy it back from the market, and therefore you have zero positions. Okay? So here I have a chart depicting the life of an option. It's very straightforward. It simply means that if you acquire an American option on 1st February and it expires on 1st of May, you can exercise this option anytime between 1st of February and 1st of May. An important point to note is that you always calculate the time to expiration or the number of days to expiration by dividing it by 365. Okay? Although some other instruments may not use a denominator as 365 because the market is not open 365 days a year, but for options, always remember you have to use 365. Okay? Because can anyone tell me why you have to use 365 days, notwithstanding that options are not traded on weekends or on public holidays? What do you think is the reason, sir? What do you think is the reason? Okay, because options has time value, right? Okay, which we will talk about in subsequent lectures. So with each passing moment, each passing day, time value decreases. Okay, time value diminish with each passing day. So you can't say that just because an exchange is not open, you can't trade the options. It doesn't lose time value. It continuously loses time value. Okay. Okay, exchange traded or exchange listed options have got all of this. It typically takes something like 6 months to 2 years to list an options. If you check out ASX website, which you will have to do for your tutorial 1, you will be able to find what is called a contract specs. Okay, contract specifications. Now, contract specifications tells you a lot of things, and I would urge you to be familiar with contract specifications right from the word go. Okay, it tells you what is the minimum take, what is the minimum price fluctuation of product, when is the expiration date, what is the delivery method, and so on and so forth. Okay, so those are very important. It may not seem that way to you now, but those are important not just from an assessment perspective, but also as you move into doing your assignment later on. Okay, you need to understand these things. So three main websites that you can check. Australia, because for options we're going to look at Australian market for examples. For futures we're going to look at Singapore market for examples, and Chicago CME or CBOE is of course what everybody trades in the world, right? So we'll look at that as well. Okay, here's an interesting slide. Now, I want all of you to fully understand the information contained here, because in your trading assignment, you're going to look at things like this as well: prices, open interest, volume, and things like that. So you need to understand what they are so that you can do well in your trading assignment. And if you trade, of course, you need to know this even more, right? Does anybody trade here? Does anybody do any trading? No, do you? Nobody? Does anybody plan to? There's a lot of money in the market, right? Okay, so now here I have the underlying as ANZ stocks. Okay, so June 12 is the option series. So this option expires in June. Okay, is this a call or put? What do you know? Can you tell? Who thinks he or she can tell? Is this a call or put? What do you think, sir? Yeah.
Well, I think it's a call.
Why? Okay, whatever reason you think is going to be wrong, I'm just giving you. Okay. You can't tell, right? How can you know whether this is a call or put? Because I didn't indicate. Right? So if you look at an option series, it will tell you whether this is a call or put. So I deliberately didn't put this because I want to talk about both sides, whether it's a call or put. Okay? Now, if this were a call, okay, the strike price is $16. The stock price, underlying price is 16.74, strike price is 16. Strike price means this is the price you have to pay if you were to exercise the call. And this will also be the price that you collect if you were to sell an option. Okay? So if this were a call, are you profitable or not? No. If this were a put, would you exercise it? Where did that come from? Yes. Why would you exercise it? No, you're right, you're right. Now, I want you to speak up a little bit so that I know whether you got the idea or not. So what do you think this is? So you will exercise this put, will you? Yeah. Okay.
Because I probably think that's an upside opportunity.
So what is your profit from here if you exercise the put?
$16.
$16 minus 15.74. Okay. Now, if you were to consider the fact that you have paid a premium, would you still exercise it?
Not sure. Because I don't know how
Okay, if you were to buy, would you be buying at 57 cents? Bid and ask means, bid means what people are bidding to buy, ask means what people are offering to sell. So if you were to buy, at what price would you be paying, 57 cents or 47 cents? 47 or 57? If you are buying 57, right? Because if you are buying, you always pay the offer price or the ask price, and if you're selling, you always sell at the bid price, simply because that's the lowest price anybody is willing to buy or the highest price anybody is willing to sell. So if you bought this put, you would have paid 57 cents for it, right? Which means that would have eaten up your profit of 26 cents, right? Now, volume simply indicates the transacted volume. Open interest refers to outstanding contracts. Sometimes you don't see implied buyer or seller volatility. You only see one figure for volatility. Okay. Now, what is open interest? Again, this is something you have to understand when you do your trading assignment, because open interest in your trading assignment is updated in real time, so it pays for you to be able to interpret that. So what is open interest? It refers to number of outstanding contracts. So outstanding contracts means contracts that have not been closed out. So if I buy a contract and I sell it, I have no more position, right? It's closed out. Does everyone understand? So if I buy a contract and you sold a contract, but I haven't sold mine yet, you haven't bought back yours yet, so that remains as open interest. Okay? Is that clear or not? No, I'll illustrate that for you. Is that clear? No. Who would be happy to offer me a piece of paper? Well, I could write on the board, but then it wouldn't be recorded. You can keep this paper after that. I'll autograph it for you. Okay, so okay. Okay, so let's say we have party A and party B, right? So party A buys 2 contracts. Somebody has to sell, right? So let's say party B sells 2 contracts, okay? So long and short or buy and sell has to be equal, right? Because if somebody wants to buy, somebody has to sell. If somebody wants to sell, somebody has to buy. So what is the open interest here? +2, right? Because both of them have not closed out their contracts, right? They have not closed out their positions. Does everyone follow? Yes? Now, let's say C comes into the market, bought another 2. D comes into the market, sold another 2. So open interest, what happens? Another +2, right? Because everybody has not closed out their contracts, okay, or their positions. So now you have 4 open positions. Now let's say A closes out his position. And let's say D also closes out his position. Okay? So what happens to open interest now? No, just from this transaction. +2, -2, no change? This is a real question this time. Alright, I hope you don't feel offended. What happens to open interest now? No change, or +2 or -2? So remember, open interest is contracts outstanding, not being closed out. So now party A initially bought 2, now sold 2, so close out his position, right? So he has no more open interest, right? What about party B? Also no more open interest, right? So what happens to total open interest? +2 or -2? -2, right? Because party A has closed out his position, party B closed out his position. So what do you have? So this is gone, right? Because initially we have 4, take away 2, right? Does everyone follow? Yes or no? Don't follow? Okay. Open interest is defined as contracts outstanding. Outstanding means it has not been closed out. So if I buy 10 contracts and I have not sold it back to the market, then open interest is plus 10, right? Agree? Or, now if I sell it back to the market, I sell all the 10 contracts I bought to the market, then I close out my position, right? So I started off with 10 contracts, which increases open position by 10. Now I've sold it out and closed all my position. So open interest would have to take out the 10, right? Because now I have no more open position. Follow or not? Yes or no?
But how did the minus 2 come about?
What do you mean?
That one, minus 2.
Which one? This one? This one?
Yeah.
This one, because this no longer exists, right? Because I've closed out my position. I've closed out my position. So here I have 4, right? Total. So if this 2 has closed out position, which means this is also taken out, right? Yes or no? Well, it doesn't have to be this. It can be this. Well, if I put it here, maybe it's clearer to you. Okay? So this is correct. So then this closes out. So I'm left with 2, right? Yes or no? Yes or no? Okay, let me try again. Okay, A plus 2, B minus 2, open interest. Everybody happy with this?
Yes.
Everybody happy with this? Okay, so long and short open interest is always the same, right? Because if somebody buys, somebody has to sell. So although plus 2 minus 2, because they have both not closed out, so of course open interest increases by 2 contracts only, right? So now, let's say party A sells 2 contracts. Okay, so this is gone now, right? And party B initially sold 2 contracts, now bought back 2 contracts. So this is also gone, right? So how many should I take away? What is the total now? Let's say nobody else comes into the market. What is the total? Left 2, right? Agree? So I'm left with 2, right? So which means open interest decreases by 2 as a result of this transaction, right? Still no? Yes or no? Okay, I'll give you another example. Maybe it becomes easier. So let's say this one didn't happen. Okay? So A sold 2. Now somebody else comes into the market and bought 2. Okay, somebody else comes into so instead of B now, so B still keeps his 2 short positions. E comes in and bought 2 contracts. So A sold 2, so A's position is closed. Now E has got a new position. So what happens to open interest now? This one, right? This and this. What happens to open interest? Increase by 2, decrease by 2, or what? No change, right? Because even though A closes his position, a new player comes into the market, right? So what is the total open interest? It's still 4, right? Yes or no? Okay, now there's more yes. Yes or no? Is it confusing?
Yes.
Okay, think about it, okay? It is actually not so confusing, but maybe because you're seeing it for the first time. So essentially what this means is that A plus 2 sold his position, so this cancels. So somebody has to buy 2, right? Now if an existing person buys 2, then of course now 2% close out the position, right? So of course open interest reduces by 2. Now if none of the existing players bought back the 2 position, but somebody new comes in and buy, then there's no change, right? Yeah? Okay, think about it. If you still don't understand, you can ask me after the lecture or ask me next week or whatever. Okay, so OTCs, over-the-counter transactions. So what we're looking at with regards to options so far are all exchange-traded options or exchange-listed options. Now, over-the-counter options are options which are not traded on the exchange. They are transacted privately between parties. Okay, so as a result of that, you find that they are very customized with respect to delivery date, with respect to price, with respect to quantity, quality of the product, and so on and so forth. Because if this is a negotiated contract between you and me, we can agree on anything we want to agree, right? Separate from the market. Agree? Yeah? So that's what OTC contracts are about. And of course, because it is not exchange regulated, there are attendant risks to it. There are things like liquidity risk, default risk, credit risk, and so on and so forth. Because if I buy an option from you and I want to exercise that, you choose not to give me the underlying, there's nothing, well, there's not nothing, but there's not a lot of things I can do, right? It takes a lot of money to sue you, whereas if these are exchange-traded options, they are bounded by the exchange, and the clearing member would honor your part of the bargain even if you default. Okay, so there's less risk with exchange-traded options. So we'll talk more about OTC market when we do forwards. Okay, long position and short. Now, I want to emphasize that you need to be very clear with the terminology. Okay, what is long, what is short, what is call, what is put, what is intrinsic value. All of this you have to know very well. Okay, not only because you're going to move forward using these terminologies. If you come out and work in the market, people are going to talk in the same terminology as well. So you need to understand this. Otherwise, you find that you're going to have a lot of difficulty as we progress in the course. Okay. So to go long simply means you are the buyer or the taker, right? And to go short simply means you are the writer. So sometimes we don't say. So in an exam question, we can say that you are the buyer, but we can also say that you are the taker. Okay, so you have to know exactly what that means. Is it hard to remember whether you're taker or writer? No. Okay, I'll give you a tip on how to remember that if you forgot. Okay. Now, when you buy, you take the right? Because an option gives you the right. So when you buy an option, you take the right. So therefore, you're the taker. Okay, when you sell an option, you undertake the obligation, right? You undertake the obligation to deliver. So what does that mean? Yeah, sorry, you underwrite the liability, right? When you sell an option, you underwrite the liability to deliver. So therefore, you're a writer. Okay. So if you remember it that way, it's probably easier for you. Now, show me the money. Well, if the strike price is the same as the underlying price, so S always indicates the underlying price. Okay. So if S is equal to X, it's called at the money. If it's close together near the money, in the money means the underlying price is greater than the strike price for a call. What about a put? So if the underlying price is less than the strike price, is your put in or out of the money? What do you think? You. If this is a put and the strike price is higher than the underlying price, okay? Strike price greater than underlying price or underlying price less than strike price, and this is a put, are you in or out of the money? With this definition. In or out? In or out? In the money, right? Okay, one way to remember this is that with a call, do you want the strike price to be higher or lower than the underlying? A call.
Higher.
Higher, right? Why higher? Because it simply means that you pay the strike price, and if the underlying price in the market is higher, you can sell back at a profit, right? Agree? So the converse is true with put. If you buy a put, this is what you pay, correct? Yeah? So do you want this to be higher or lower? If you buy a put, you see, very often students get a bit confused when you switch to puts. And that's not surprising because this is the first lecture, right? But you need to be able to wrap your head around it. So one more time, if this were a put, right? So you buy a put, if you were to exercise that put, you would pay what? Pay X, right? Agreed? So do you want X to be higher or lower? It's wrong. It's a trick question. Okay, real question this time. You buy a put. That gives you the right to buy or sell? Sell. So do you receive X or do you pay X? Receive X, right? Now you wake up. Because the trick question was you pay X. Okay? So you receive X. So if you receive X, you want S to be higher or lower than X? Lower, right? Because if I buy a put, it gives me the right to sell, and when I sell, I collect X, right? So if I collect X, I buy back the stock at a lower price and make a profit, right? Yes or no? Okay, it's not that confusing. You just need to think about it. Okay, it gets easier once you sort out the basics. Which is why I keep on emphasizing that first lecture is actually very important because you need to be totally familiar with the terminology. So intrinsic value or theoretical fair value is the value of the option if it were to expire. So what is the value of an option? It's always the difference between S and X, right? S underlying X strike price. So the value of an option is always the difference between S and X. If it is a call, then you are in the money if S is greater than X. If it's a put, then it's the other way around. Okay? So that is the intrinsic value of an option. However, you can find that even though a call is out of the money, it is still trading at the price in the market. Okay? Why is that so? So we're saying that the value of an option in the case of a call is S minus X, right? Agree? Okay? So if this is positive, then of course your call has a value, right? Agree? Now sometimes this is 0 or even negative, yet this call is trading for a price in the market. But clearly from this definition, it tells you that the option has no value. So why do you think people still want to pay a price for the call? Yes? Yes. Yes. So what is that? There's a term for it. I'm looking for a term. What value is that? Time value, right? Time value is speculative value. So you're hoping or you're speculating that that difference might turn positive later on. So therefore, the option is still trading at a price. So what this reminds you is that option value comprises of intrinsic value plus time value. Okay? There are two components to the value of an option. Okay, market efficiency, arbitrage, and law of one price. Who can tell me what is arbitrage? Very quickly. Okay, arbitrage simply means that identical products trading at different prices in different markets. Okay, so let's say this pen is trading at $1 in Australia trading at $2 or 2 yuan in China. So two different markets, right? But identical products. So identical products trading at different prices in different markets presents an arbitrage opportunity, right? So you can buy the product at a lower price in one market, sell it at a higher price in the market, and therefore make a riskless profit, right? So essentially, arbitrage is money for nothing, right? There's no risk. Now, however, if many people do that, then prices quickly converge into one price, right? So that leads you to the law of one price. So the law of one price, therefore, states that identical products must fetch the same price in different markets. Of course, taking into account relevant costs such as foreign exchange and so on and so forth, because you can't say that this pen is selling for $1 in Australia, it must sell for 1 yuan in China, right? Because clearly there's a foreign exchange involved. So after taking into account of relevant factors like this, the law of one price states that they must fetch the same price. Okay? So essentially, it's one way of looking at purchasing power parity. Is that clear to all? If you don't understand, you got to speak up, yeah, so that I can explain it differently to you. Okay, mechanics of buying and selling. Although in this time you don't actually see this as being very obvious, but whenever you want to trade, you have to go through a broker, right? Or go through what is called a clearing house or clearing member. Now, so whether you're buying or selling, you have to go through a broker or a clearing house, and some of you may be using Comsec, some of you may be using somebody else, but those are essentially your broker or your clearing house. Now, transaction cost is something that you will notice in your trading assignment, so I'm going to talk a little bit about transaction cost. So when you buy shares or options or anything, you have to pay a cost, right? So your broker will tell you usually that is, let's say, 1% of the transaction value, or it's a flat fee of $10 per trade, something like that. So what is that transaction cost? They will tell you this is brokerage fee, okay? Now, you need to understand that within that, there's actually many components. Okay, one transaction cost that a broker tells you comprise several other things. Okay, it comprise order filling fee. Okay, to fill your order, it comprises clearing member fee. So the clearing house charges you a fee. It also includes exchange fee. Okay, and of course, it can also include bid-ask spread. It can include spillage costs as well. And in terms of orders, what kind of orders can you place in the market? There are several orders that you need to take note of, again, because you're using the trading platform, you need to know. So one of them is, are you taking the lecture after this? Or you taking a lecture after this? Give me 5 minutes or so. I should be done soon. Okay, so in terms of types of orders, you have what is called a market order. Now, market orders are orders for which you place at the best bid or best ask. Okay, so you take whatever the market throws at you. So why would anybody want to do this? Because time is of essence, right? You want to get into the market quickly, or you want to get out of the market quickly. So time is very important to you, so you place a market order. So there are also orders called limit orders, for which you specify a price that you want to enter the market. Okay, so you can specify a price you want to buy, specify a price you want to sell. So these are limit orders. Now you also have stop orders. Stop orders can be limit orders. They can also be market orders. And then you have a range of other types of orders as well. You have time-based orders. So time-based orders are things like MOO or MOC. It means market on open or market on close orders. So you can place an order with your broker to say that I want to place a MOO order. It means when the market opens, you take the order, the price. You can also have volume-based order, which is all or nothing, for example. AON orders, which means you want to buy all or nothing, right? Or you want to sell all or nothing. There are other variations like fill or kill, fill and kill, and such things. Okay, we've talked about open interest and how they can indicate liquidity in the market to you, an indication of demand. PutCall ratio is another one that you can look at. Okay, Now, if last question for today, if a put-call ratio is high, what does that indicate? Put-call ratio, right? So put over call. So if put-call ratio is high, is that bullish or bearish? How about you, man? Yeah, you. A high put-call ratio, what does that indicate? Okay.
It's very.
Somebody said the right answer, right? Now, put means you want to sell, right? You sell when the market goes down. Call means you want to buy, and you want to buy when the market goes up, right? So if the put-call ratio is high, what does that mean to you? Okay. Okay, so the next two slides are on taxation, which I want you to read on your own because there'll probably be a question on that.
Excuse me, I really have a tight schedule.
Yeah, I'm done.
Okay.
So please read the taxation slides.
Sorry, I didn't want